In today's video, I'll be explaining a bit about recessions and how you can best prepare for one with certain strategic approaches that I'll be showing you at the end. Inflation is the most relevant economic issue that the world is facing right now, and there have even been recessions caused mostly by inflation that is less than what we're seeing right now. When the US is in a recession, more often than not, the world also experiences one. There are three clear recent examples of large-scale economic recessions, or worse, depressions. There's the stagflation of the 1970s, the dot-com bubble from 99 to 2001, which largely helped contribute to the financial crisis from 2007 to 2008, also known as the Great Recession. And we're either standing on the edge of or are beginning to fall into a recession right now. To better understand what it looks like when in one, the conditions leading up to it, and how to spot the recovery, we're going to take a look at a couple of examples that I'm going to cover. And then I'm going to explain how you can best prepare for it and even profit from it to make it out better than the average person. And this is not financial advice. Recessions are frequently a feedback cycle that leads to falling GDP and rising unemployment. Consumers spend less for whatever reason, often inflation or fear of a future recession, which actually can lead to a self-fulfilling prophecy if enough people believe it. This causes businesses to make less profit and lay off workers, and this scares the economy more, and people prepare for the economic downturn by continuing to limit their spending, and the cycle continues. The cycle leading to this downward spiral can also start at any one of these points. The 1970s saw the worst economic conditions at the time since the Great Depression, and it was largely started by the oil embargo from OPEC, the organization of the world's leading oil exporters, which led to an energy shortage and prices rising rapidly. The US had to cut spending elsewhere, and while this was happening, President Nixon passed the Economic Stabilization Act of 1970, which was meant to deal with high inflation and enact wage freezes. Lots of businesses couldn't manage to pay their employees at this fixed wage rate since their energy costs were much higher and were struggling to maintain profits. So this led to large layoffs and rising national unemployment. This meant a stagnant economy with high inflation and lower consumer spending, which is called stagflation. There was a 3.4% reduction in GDP and the unemployment rose to 8.8%. To account for this, the Fed lowered interest rates to help stimulate the economy and help employment. But this would only push the problem back to later down the road, while inflation gradually got worse in an economy that was recovering, but headed towards dangerous levels of inflation that reached about 13.5% by 1980. Then there's the financial crisis of 2008. This was the new worst economic state since the Great Depression. It was devastating to real estate and other businesses, not just in the US, but around the world. The housing market had been thriving and booming for most of the 2000s, and real estate was appreciating at unprecedented rates, as home prices had never depreciated for any meaningful period since the Great Depression. The economy was doing so well that it became too easy to get a loan. Lenders didn't see much risk in loaning money to people with bad credit, since it was assumed that home prices would continue to increase. Investment firms were buying this debt from banks and then turning it into an investment vehicle by bundling it and calling it a collateralized debt obligation, also known as a CDO. These consisted of high-risk loans, subprime mortgages, mixed in with safe loans to create a basket of debt that was actually incorrectly classified as low risk, while also providing high returns. Debt rating agencies were essentially paid more to give these false ratings so that banks and investment firms could make more money. If it's too good to be true, you're either getting scammed or it's not going to last much longer. And all it took was interest rates to eventually be increased for this chain reaction to begin, setting off the cataclysmic downfall of the real estate market and the financial markets. Once it did in 2006, when higher interest rates began to take more effect, more people were defaulting on their mortgages, homes were being foreclosed, and this led to the downward spiral of the market that accelerated to affect more and more people and then outside of the US. This contagion that was these financially engineered mortgage-backed securities had blown up all over the world and was felt for many years after that, and it could arguably still affect us today. The two main indicators of a recession are falling GDP and rising unemployment. In every recession since World War II, in which there have been 12, GDP decreased and unemployment increased. Interestingly, though we have seen GDP down in the last year, unemployment is somehow falling as more people are getting jobs. But consumer sentiment is at levels that are similar to what they were in the 2008 recession. The good news is that companies have seen historically very high profit margins, with average quarterly profit margins having been in the high double digits over the last 12 years. This fortunately means that companies have a lot of cash as a cushion to fall back on in case of a recession, and hopefully not have to lay off workers which they definitely don't want to have to do for as long as reasonably possible. Companies don't want to have to go through hiring and training more workers again, especially with how hard it is to find labor and retrain them. As long as things don't get much worse, companies with their loaded treasuries can potentially prevent this self-feeding cycle, which often results in a recession, from occurring. In the 1970s, the lingering inflation as a result of low interest rates to account for a struggling economy with rising energy costs remained a problem until the early 80s. But even after the Iranian Revolution had ended, the new regime continued to manipulate the oil supply, which kept oil prices high. To combat the effects of this and the lasting inflation from the 70s, the Federal Reserve raised interest rates all the way up to an insane 21% as a trade-off for beating inflation and long-term economic recovery at the expense of short-term economic growth, which shrunk by 3.6%, and unemployment, which peaked at 10%. Paul Volcker understood the need for short-term pain in order to realign our economy in the right direction. The economic problems of the 70s and 80s were mainly caused by external events, but were worsened by how it was handled by the United States. But in 2008, this was the result of internal financial institutions speculating and getting greedy. As a result, this current younger generation is expected to be the first ever to be poorer than their parents on average. These recessions are very much out of the control of the majority of people, but people can position themselves to not only recover from a recession, but to seize the opportunity and to actually profit from it. Before I share with you what I learned from the best experts in the world on how to prepare for a recession and make the most of it, I have to say that none of this is financial advice. The first thing to keep in mind is don't sell your good stocks whose fundamentals haven't changed, even in a downturn. Buy more. And don't take my word for it. Here's a clip from Warren Buffett, the world's greatest and most successful investor.
So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money.
He also says to buy companies with good cash flow and that have a competitive advantage that you and others believe will last in the long term. These are considered good fundamentals, along with other measured qualities, but these are often the most important, especially to Warren Buffett.
I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. You know, if you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that.
This next strategy is dollar cost averaging, and it's pretty universal across good financial advisors. And it's the old saying, time in the market beats timing the market. Don't treat a market downturn as a one-time buying opportunity. Rather, take advantage of many buying opportunities to buy healthy, revenue-generating companies for undervalued prices. There's no way to know what the bottom of the market will be or when it will be, and anyone who says that they do know is either trying to fool you or has fooled themselves. There's simply too many factors that no one could possibly account for all of them to know exactly when to buy whatever it is you want to buy. Rather than trying to time the bottom exactly, invest incrementally on some set time interval, like every week, every month, whatever it is. Of course, it's more advantageous to invest when the market is down from its highs, but significant market crashes actually rarely occur. Post-World War II, the S&P 500 has only seen 11 crashes that resulted in a 20% or greater drawdown. Maybe that doesn't seem like very few, but on average, that's once every 7 years. Therefore, you shouldn't just wait for one of these rare market crashes to go all in on investments. Dollar cost averaging takes most of the emotions out of the equation. By buying on a consistent basis, regardless of whether the market is up, down, or sideways, over time, you will either lower your average cost if the market keeps crashing, or continue to build a position that becomes more and more in profit if the market is soaring. You could do this by investing, say, 20% of every paycheck, whether it's once a week or every other week, or if there's money already set aside to invest, and say over the course of 6 months, you could invest 4% every week. Arguably one of the best strategies that financial experts around the world preach is diversification.
Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. It transformed the American landscape. But if those 2,000 companies, 3 basically survive, and they haven't done that well.
Very few people can accurately pick the winners of any given industry, and whether it's already well-established brands and you're trying to decide who will remain in 20 years, or if it's something as new as cryptocurrency and you want to know who will still be around in 3 to 5 years, it's important to do your research and it doesn't even have to be a deep dive. Maybe take a look at what a few of the top experts are recommending, and then compare between them against each other to figure out what might work. Spread risk across different kinds of asset classes, and buy a variety of assets within a sector. These are not my opinions, these are just what the best financial experts in the world have to say about finance. And I would argue that the second most important is, assuming that you have income, do not sell when the market is down. Buy the dip, as they always say, and just keep buying good companies. That's it for today's video. If you guys found that helpful, hit the thumbs up, and I'll see you guys in the next video. Peace.